You find out you should have registered in a state, and you do the math based on the statute of limitation. 3, maybe 4 years of back tax, that's painful, but survivable. But that cap isn't automatic, and if you've never filed, most states don't have to honor it. We've been unwinding this situation since 1999, and I'll show you where that cap comes from and how to get it back. Let's start with the rule that's actually true, because it's the reason this surprise lands so hard. Most states put a limit on how far back a sales tax audit can reach, and it's usually 3 or 4 years. California's general rule is 3 years from the date you file. That limit is real. It's written into state law, and it's what gives an audit a floor, a worst case you can actually put a number on. But everything I just said depends on one word, and it's the word almost nobody reads. Here's the word: filed. The limit doesn't run from when your sales happened. It runs from when a return was filed, because a filed return is what starts the clock. So if you never filed one, the clock never started. And in many states, there's no limit at all on how far back an assessment can reach. California is the clearest example, because the same law that gives you 3 years stretches to 8 when required returns were never filed. And in states that believe sales were deliberately hidden, there's often no limit of any kind. So the businesses carrying the most exposure aren't the sloppy filers, they're the ones who never filed anything. And if any of what comes next sounds familiar, that open clock may already be running on you. But how do you or anyone else end up never having filed? Well, almost nobody chooses it. It happens because the obligation started somewhere you weren't looking. Economic nexus gets all the attention, the dollar amounts and the transaction counts, but it's one trigger among several, and others usually arrive earlier and quieter. Here are 4 to consider. First, physical presence has no threshold at all. 1 employee, inventory sitting in a third-party warehouse, staff working a trade show, any of those creates the obligation from day 1 at any sales volume. And this is the one that catches e-commerce sellers, because third-party fulfillment moves your inventory into states you never chose. Second, your home state counts from your very first sale, because where you actually operate, there's nothing to cross. Third is sales tax you've already collected. If your platform was set to collect in a state before you registered there, that money belonged to the state the moment it was taken. And until you register, you're sitting on funds that were never yours. And fourth, marketplace sales can still count. In some states, sales you make through a marketplace count toward your own threshold, even though the marketplace remits the tax on them. Most sellers assume those sales aren't their problem. With all of this said, let's be clear about what an open look-back costs, because it isn't just a longer version of the same bill. 3 things stack. There's the tax itself, going back as far as the state chooses to reach, then the penalties on top of that, then interest which accrues from each original due date. So the oldest periods, the ones a normal audit could have never touched, carry the most interest of all. And here's what makes it worse than an ordinary assessment. None of that tax was ever collected from your customers. In a normal audit, the fight is over whether tax was calculated correctly on money that already changed hands. Here, it never changed hands, so you're paying it out of your own margin years later on revenue you've already spent. Which brings us to the only question that actually helps you. What do you do about this? Here's the takeaway you can act on today. There's a tool built for this situation, and it comes with a deadline nobody controls. It's called a voluntary disclosure agreement, or VDA. And it's an agreement where you go to the state before the state comes to you. In exchange, the state typically limits the look back to 3 or 4 years, which puts the cap back on and waives the penalties. It turns open exposure into a defined number. Now, you still file the past due returns because the look back gets shortened, but the filing still has to happen, and it carries 2 conditions. You have to come forward before the state makes contact, and you need a clean record in that state, which means the tool that fixes an unlimited look-back disappears the moment you find out you need it, because an audit notice doesn't just start an audit. It closes the best way out. And filing these agreements is a core part of what our team does. And if you'd like to get in touch with our team and get some assistance in that regard, go to handsoffsalestax.com shopify.com/contact and set up some time with our team to help you through this process. But all of this is about beating the state to the door. But do you know what happens once an audit actually starts? For more information on that, check out this video. And remember, when in doubt, always consult with a sales tax professional.